Banking conditions in Minnesota and the Twin Cities for the first quarter of 2014 showed only limited gain. I'm Ron Feldman. I'm the Executive Vice President for Supervision, Regulation, and Credit here at the Federal Reserve Bank of Minneapolis. And today I'm going to discuss banking conditions in Minnesota and the Twin Cities as of the first quarter of 2014. And that's going to be for all the banks that are headquartered in either Minnesota or the Twin Cities. Before I get started, let me just remind you that Minnesota and the Twin Cities are part of the 9th Federal Reserve District, and we've got lots more banking data on our website, and you can see the address here if you want to get into more details. So turning to the first quarter for the state of Minnesota and the Twin Cities, I'm characterizing it as a limited gain. You might say it was sort of a mixed quarter, but I would say it's more of a negative mixed quarter than a positive mixed quarter. So let me describe in high levels what we saw, and then I'll provide a little bit more detail on each of these points. Problem loans, which are loans that are not paying on time or on full, were at a pretty flat level, but they're already pretty low to begin with, and so we weren't expecting much improvement. So that was pretty consistent with what I was thinking was going to happen. The real negative was in profitability. So profitability was flat for the state of Minnesota. It was a small gain for the Twin Cities, but not much. And what's a little bit disturbing about this is the first quarter is normally the time of year where banks in the state see a gain. And so the fact that there wasn't a gain here is a little bit noteworthy. And we also see that net interest margin, which I'll describe in more detail later, which is a primary source for banks' income, was flat. On the positive side, loan growth was up, and in the long run that means that we're going to see profits rising too at some point, but just not yet. So let me give a little bit more detail on all three of these points. So first we're going to look at the standard graphs we've been showing you for some time. On the top is the state of Minnesota, and on the bottom are the Twin Cities. So the red lines are for Minnesota, the blue lines are for the Twin Cities. And you can see that there's a dark black line for each of these graphs, and that shows you the 20-year median. So think about that as being sort of what we would expect in the long run, or what we have been seeing in the long run. And you can see for both Minnesota and the Twin Cities, the median bank, that's the bank that's in the middle of all the banks, is below what we've seen for the last 20 years over more of a standard time. And again, that was flat, but we would expect it to be flat given that it's already at a fairly low level. And just to make the point that this is really what we've been seeing for some time, and we're really a long way past the financial crisis. The next graph is showing you commercial real estate, showing you the same sorts of graphs, with Minnesota on the top, Twin Cities on the bottom. And again, these are problem loans for commercial real estate, which are loans made to firms that are secured by commercial real estate. And this is really where we saw many of our banks get into problems. And here too, you can see it's back to pre-crisis levels, or almost there. Even other real estate owned is improving and getting close to back where it was before the crisis. Other real estate owned are properties that a bank seizes when essentially a loan can't be paid off. And you could see that that spiked during the crisis and is really starting to come down. So problem loans were flat. They're already at low levels. I wasn't expecting to see much gain here, or the gains that we did see were expected. So I would say this is just sort of normal. Now what's more problematic, as I mentioned, is profitability. Now here you can see the 20-year median for both the Twin Cities and Minnesota. The actual observations are below that. Not only are they below that, for the state of Minnesota, they're very flat. So there really hasn't been any indication, if you look at the median line, that it's going to be crossing the 20-year median. For the Twin Cities, it's a little bit of a gain, but really not much. So it looks like rather than returning to the profitability levels that we saw before the crisis, we're sort of heading towards what might be a sustained period where we're at what was maybe more normal over the whole 20-year period. And what's particularly troubling about this is that if you can look at the graph, you'll see that every first quarter for the last 4 or 5 years, there's been a big gain in profitability. Here, we did not see that. For the state, it's flat, and for the Twin Cities, it's a small improvement. And in many of these years, most of the profitability gain has come in the first quarter. So the fact that we haven't seen gain there is a little noteworthy and a little troubling, and why I would say the quarter overall was not particularly strong. So let's do a little bit deeper dive into profitability. So one source of profitability that we've talked about before is provisions. So provisions are not normally a source of profits, they're normally a cost. These are the funds that banks set aside to absorb future losses on loans and securities. But what's been happening is that banks put less and less money aside for provisions. Their profits go up because relative to the last quarter, they're putting less money away. And in some cases, they're even taking money out of their old provisions, and that's coming in as income. But what's happening now is that the median provision to asset ratio for banks is actually at 0. So what heretofore had been a source of profits really can't be one going forward, or not at a very high level. And then when we turn to net interest margin, which is the difference between what the cost that they pay to get funding and the earnings they get by making loans and buying securities. That's really the main source of income for most banks in the Minnesota and the Twin Cities. And you can see that's been decreasing for some time. So in sum, profitability was not strong in the first quarter. It was flat for Minnesota and only up a little bit for the Twin Cities. Provisions, which have been a source of income, are basically at 0 relative to assets for the median bank, and net interest margins, which are the normal source of income, are continuing to fall. So that looks like it's makes me think that we're going to be heading maybe back to a period of flat profitability rather than one where we are going to see much growth. On the upside, however, we are seeing some growth in loans. So this is looking at year-over-year loan growth. You can see that there was a strong increase in loan growth in Minnesota, almost back to the 20-year median. It was flat in the Twin Cities, so it's not as positive there, but for the state as a whole, it is up. And over time, we would expect as loan growth increases, that banks will make more money because they tend to make more money off of loans than their other assets. Another way of looking at the same data, and looking maybe even more starkly at the difference between the Minnesota and the Twin Cities, is the following graph, which shows you the percent of banks that had loan growth. It's over 70% for the state, and it's not yet 60% for the Twin Cities. So let me summarize. We are looking at 3 measures for this quarter: problem assets, profitability, and loan growth. In some, you could say at best it was a mixed quarter, but at worst I would say it's sort of not much of a gain, even a slight weakness because of the issues with profitability. Of course, if you've got questions or comments, we'd love to hear from you. So thanks very much.